Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Volatility term structures have made remarkable moves since the beginning of the Russia-Ukraine war. Joining me to discuss is Steve Sosnick, chief strategist at Interactive Brokers. And Steve, this is something that you've really been following closely since, the 4, 5, 6 times we've been on just in the past 4 to 5 weeks with the Russia-Ukraine conflict. And it's really the spreads in the term structure that have caught your eye.
Oh, yes. Well, first of all, thanks for having me once again, Jill. It's really been quite remarkable because we've seen the term structure go from fairly inverted. As the conflict was getting underway, call it a month ago. The term structure began to invert. Then about 2 weeks ago, just before the Fed meeting, it really got very steep, meaning that the near-term options had implied volatilities well above the near-term option, well above the options in outer months. If we look at a graph of the term structure, we can see how that changed pretty much, from somewhat backwards, from a slight backwardation to a massive backwardation. And now we're back at what, at contango, at what appears pretty normal. And the longer-term volatilities, which had risen fairly dramatically about a month ago, they're back to where they were beforehand, which is kind of what you'd expect. I think the longer term volatility assumptions are not really rooted in the day-to-day of the conflicts. It's more that's more general market tone and Fed and fiscal stimulus and stuff like that. But the shift in the front end of the curve has been wild and dramatic, and that's led to a lot of trading opportunities, if we want to look at it in the most positive light.
Right. And if we take a look at our next chart here, which is NDX and QQQ, we can really see that term structure with that remarkable round trip that you were discussing. So I guess it just makes traders think, are we, at the precipice of moving beyond this conflict? Or, we don't know fundamentally what's going to happen, but is there anything that we're seeing from the volatility markets that could suggest either more choppiness or we might have found some middle ground here?
I think the speed at which we went from somewhat nervous to extraordinarily nervous, now back to, I'm going to say, relative complacency. We're not quite at levels that I would say are absolutely complacent, but we're getting there. That to me causes its own headaches, because I think it's really strange when you see market consensus flip that quickly. We understand why we got nervous. It's the combination of this, the Fed's activity scaring people to some extent, and of course the Russia-Ukraine conflict really causing a remarkable and unique set of challenges, both for the markets and for the world. But then to just sort of say, okay, the Fed meeting is behind us. It wasn't as bad as feared. Let's just take off and let's just resume, almost as though nothing has been happening. And I'm saying this in stock market terms, not in global terms, not in a wide range of commodities, but in terms of a lot of the stock market sense and overall volatility, we're sort of acting as though, we're out of the woods to some extent. And it's not clear that that's the right response either right now. I think it's somewhere in between.
Right. And it's so interesting, Steve, because you had noted an article in the Wall Street Journal talking about the return of speculative trading. So I want to touch on that a bit, because when we look at ticker symbols that are the most active within the interactive broker community, we see a lot of the levered ETFs that have certainly been in favor with the interactive broker traders. So, when you think about that, you think about speculative trading, and levered and inverse ETFs also have their own set of risks as well. It was just interesting to see how that coincided with your thoughts around complacency and then the journal reporting on perhaps more speculative trading.
Yeah, the journal article, really highlighted that the levered ETFs are back. Actually, I will say that our customers are somewhat more conservative than overall, because the article highlights that year to date, the most actively traded exchange traded product, ETP, which encompasses both ETFs, exchange traded funds, and exchange traded notes. The most actively traded ETP was TQQQ, which is, triple levered QQQ, followed by SPY, followed by UVXY, Ultra VIX ETF, followed by QQQ, then SQQQ. And so you have, which is the triple levered inverse QQQ. And what to me is fascinating is that you have the tail wagging the dog. That, you know, that TQQQ trades more than QQQ, or that SQQQ combined with TQQQ far outpace the ETF upon which it's based. That's great for you at Nasdaq. These are all Nasdaq traded instruments. That's, you know, that's wonderful for your volumes. What's interesting at Interactive Brokers is we do still see QQQ above TQQ, but only very slightly, and even there. So this to me is saying that traders are embracing risk. You don't trade triple levered ETFs unless you're really trying to capture risk rather than avoid risk. And yes, we could argue that SQQQ can be used as a hedge, but I would argue that these are ineffective hedges, and it says in very clear, bold letters in the prospectus, which unfortunately these prospectuses get underutilized. It warns in bold letters that these funds attempt to replicate a single day's, whatever the leverage amount times a single day's returns. Over time, they warn that these underperform. They might be good for trading. And that's really up to you and your own risk tolerance. And we can get into that at another time, because that's a whole topic in and of itself. But there is a real cost to holding these overnight. The prospectus warns you of it. If you're in an ETF that has leverage, by definition, it has to hold derivatives. That's the only way it can accomplish its goals. As a result, that means they're holding options that decay, or futures that need to be rolled, or some combination of both, options that need to be rolled, et cetera. Those are costs. And over time, those costs will eat away at your returns. So these are very difficult products, and they're often misunderstood. And while they have real value for traders, they can really get investors into a bind. And I really want people to be aware of that.
Yeah, Steve, you and I could do a whole webinar on this. It happens to be a subject that I'm passionate about. And I think part of it could potentially be the way it's marketed or the way it's conveyed through the media. But it's not just like an ETF that you put on your portfolio and you hedge it and you forget it. I think if you want to do that, you have to be a little bit more active in your hedging practices and not just expect an ETF that uses these underlying instruments to do it for you. But again, we're getting off track because you and I could talk about this for hours on end. And with that, we will have to think about lining some of that content up for our viewers over the next couple of weeks. As always, Steve, great to catch up with you. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.